So we're looking at unit trust. At this first, we look at the features, followed by advantage or benefits. Unit trust is pooling of funds from small investors by fund managers company. It's managed by professional fund managers, invest in securities, shares, and bonds, and all bonds. Also, trust deeds to bind the fund manager, trustees, and unit holders. Basically, unit holders are the investors, other investors. The securities invested are governed by the trust deed objectives. So this how in the diagram how it looks like. A trust deeds, okay, governing the trust, basically govern the trust, unit trust fund. So there'll be three parties involved: the fund manager, okay, basically the one who manage the funds. The unit holder is basically those who buys the unit trust, and the trustees. Okay. Trustee. Trustee is independent of the fund manager and acts as the custodians of the fund's assets. He or she ensures that the funds is managed according to the trust deed to minimize the risk of mismanagement by the fund manager. Fund management companies. It is government drive to stimulate the fund management industry. Many locals and foreign financial institutes set up fund management companies and launch numerous unit trust funds. Insurance companies also provide investment-linked life policies. Unit trust is an alternative for investors who are with small sums of capital, basically for investors with small sums of capital, but want a wide variety in their portfolio. Investor has to trust the fund managers to make investment decisions. With many choice of unit trusts, investor can choose the one that is most suitable for them. Unit trust. The fees and charges may include front-end charges, management fees, sales charge or the initial sales commission is a medium to long-term investments, not meant for active portfolio management. Next, we'll look at structured deposits. Structured deposits, we will look at its features and advantage, all these benefits. Structured deposits. Fixed deposit with underlying investment product. Maturity is short to medium term, 1 to 10 years. The main attraction is the potential of additional or higher returns. It's linked to the performance of the underlying investments like stocks, stock index, bonds, foreign exchange, and interest rates. Example, BPS Bank Target 120 Protected Fund. It promised 20% target return, a fixed 10% payout at 1 year end, and bearing 10%. A link to a 6 worst performance stock in the selected basket of 24 stocks. There's a minimum investment amount. Also have these features of principal protection. If the bond issuer defaults on the coupon or principal repayment, capital protections will not apply here. Normally, it applies only if it is held to maturity. No sales charge or annual management fee. For premature termination, a penalty will be incurred. Next, we look at considerations. Under considerations, there's factors to think about. Okay, there'll be needs of the investors, the investor time horizon, the risk versus return. Factors to be considered in selecting basically investment selections. Investors should know their own financial needs and financial objectives. What are the consideration they have? The financial needs and time horizon. How basically do they need the money in short term or long term? And how long they can willing to wait for the investment. Also talk about the risk versus return. What is the financial objectives? For example, maybe it could be 3 years, 3% return annually. What's the time horizon? Maybe example, 5 years, willing to wait for 5 years. So in this case, unit trust is a medium to long-term investment. Is suitable for such investors. Investors with longer time horizon requires less liquidity and tolerate greater risk, and to obtain higher long-term returns. Risk versus returns. Investors should know their risk tolerance. The type of risk is quite the type of investment that a person choose has a close relationship with the level of risk they take. So if you aim for higher returns, the investor will the investment will tend to be higher risk. If a low risk investment, you tend to be at a low risk, a low return investment with low returns will tend to have lower risk. General examples: bonds fund will be of lower risk, low return and risk. Equity funds will be of higher risk and higher return.